2 weeks ago, I took a look at the key technical levels for the S&P 500 and said that the key resistance level for the S&P 500, the level that was going to be difficult for the S&P 500 to break above, would be in the range of 2,900 to 3,000. Last week, we went to the midpoint of that range and got turned back. Now, absolutely, we can see a rise in the S&P 500 and break above this range and move to all-time highs. It's totally possible. It would be a little bit ironic, of course, for the stock market to actually be putting in all-time highs as we're rolling into perhaps 20% unemployment plus. It would be one for the record books, but it could happen. On a seasonal basis, this is the time where we don't tend to see large rallies in the stock market over the long term. The exception to that would be if we were coming off of a major recession or even just a recession itself. You can see a large rally in the stock market that happens in what I call the 6-month unfavorable period from May 6th until October 27th. We're not coming off a recession. We may be going into one, we probably are, but we're not coming off of one at this point. So from a seasonal perspective, there's not a lot of support for a strong rally to take place. Let's take a look at a couple other aspects here. Before I get into the key support levels for the market at this time, I wanted to take a look at the stocks in the S&P 500 trading above their 200-day moving average. This line represents that. So when it's going down, that means that less stocks are trading above their 200-day moving average. And when it's rising, it means that more stocks are trading above the 200-day moving average. Why is that important? The more stocks that are trading above their 200-day moving average, that means the breadth in the marketplace is greater, and more stocks are rallying together. And we can see that if we go back to 2016 here, we can see that increase in the stocks trading above the 200-day moving average as the stock market rallied. And if we go to 2018, 2019, we can see that sharp rise and a consistent rise of stocks trading above the 200-day moving average as the stock market rallied. Well, we've seen this big, huge rally here that's taken place just in the last month. But look at this. We have not seen a huge amount of stocks trading above their 200-day moving average. And it's partly the function of we've dropped so much, but it really just shows you as well that this stock market is being driven by a few stocks. Doesn't have a lot of breadth, which means it's fragile and it's more susceptible to declines. Let's take a look at some key support levels. The first level that we're going to look at here is a very minor level support around 2730. Very minor. We've touched on this level before. I think a more important level is really around 2600 for support for the S&P 500. If we break down below this level, you can see here that we did touch that point back here in 2018 a couple times. Investors might start to get a little bit concerned. The key level that I'm looking at is what I call the psychological level of support. And that's 2351, which was the level back in 2018 that we saw here. That was the low. Now, we did make it down below here in March, but it happened so fast. There's such a positive rally after. And I think investors, when they look back and they go, oh, we were back at 2351 and we broke below that in 2019, I think that's a key level of support. And sure, the stock market, as I said, could move higher from here, but this is the level on the downside I think that's going to be key for investors to start to be a little bit more negative on the stock markets, be more, the narrative might change in the stock market, something to watch out for. In this 6-month unfavorable period for stocks, which lasts from May 6th, which is coming up this week, until October 27th, there are lots of opportunities in different sectors of the market. In fact, even for the broad market in the S&P 500, it can rally from the end of June into the July earnings season. So there are opportunities in this next 6 months, but overall it's a time to be a little bit more cautious. Thank you.